Or are you walking straight into a trap? Most people are either too late or too scared to act. But here's the truth. Gold isn't just about shiny coins. It's about protecting your money when everything else crashes. Stay with me till the end because I'll show you exactly how much gold you should own and the safest way to buy it. Even if you're starting with just $50. Let's make it simple. Have you ever wondered why gold seems to always go up in value? Why do people call it safe, even when everything else is falling apart? Let's look at one big fact. Gold has gone up over 1,000% in the last 25 years. That's not a small number. It means if you had put just $1,000 into gold back then, today it would be worth more than $10,000. No special skills, no risky trading, just gold sitting quietly. So now the question is it still smart to buy gold in 2025? Or have you already missed the train? Because here's the thing. Everyone loves talking about gold after it goes up. But when it's time to buy, people get scared. They ask, isn't it too late? Has the price peaked? Will it crash now that everyone is talking about it? These are smart questions. If you're asking them, you're already thinking better than most. But to answer them, we have to understand why gold has done so well and what might happen next. Let's break this down clearly. Gold isn't like stocks. It's not a business. It doesn't pay dividends. It doesn't grow. It just exists. So why does it go up? Because people trust it. And because money, real money, is always under attack. Let me explain. Governments print more money every year, a lot more. They do this to pay debts, run programs, and avoid short-term problems. But printing money comes with a cost. Inflation. Inflation means your money buys less stuff over time.
Yes.
You've seen it happen. Groceries cost more. Gas is up. Rent is through the roof. Even your favorite coffee is now double the price. And when money becomes weak, people run towards something strong. Something is gold. Gold doesn't change. It's rare. It's real. It's most important. It's not controlled by any government. That's why gold has stayed valuable for thousands of years. Now here's where it gets interesting. In the year 2000, gold was under $300 per ounce. Today, it's above $2,400. That's more than an 8x jump. And that's after a few dips along the way. People who held gold through those years didn't panic, didn't sell. They made serious money. So why is this important to you now? Because the same forces that pushed gold up are still happening today. Inflation is still here. Debt is even higher. Money printing hasn't stopped. And trust in the system, it's weaker than ever. So ask yourself, has gold really finished its run? Or is this just the beginning of something bigger? That's exactly what we're going to explore in this video. We'll break it down in simple language. We'll show you what gold is doing, why it moves the way it does, and whether you should still consider buying it. No hype, no fear, just the facts. Plain and simple. I don't know if you stick around till the end. I'll also give you a 3-step beginner plan to add gold to your portfolio, the smart way, even if you've never invested before. This could be the knowledge that saves your money in the next big crash. So let's dive in. So, how does gold actually work? Why does it go up in value, even though it doesn't grow like a company or pay you interest? Let's keep it simple. Gold is what people call a store of value. This means it holds its worth over time. Even when paper money becomes weak, gold doesn't depend on profits. It doesn't care about elections. It doesn't crash because a CEO made a bad decision. It just sits there, solid, shiny, and trusted. Now think about regular money. It's printed by governments. Governments often print too much of it. Why? Because printing money feels like a quick fix. Need to fund a war? Print. Need to pay for big programs? Print. Need to bail out banks? You guessed it, print again. But there's a problem. The more money that exists, the less it's worth. That's called inflation. And inflation is like a silent thief. It slowly steals your money's power without making a sound. One day, your $100 fills a grocery cart. A few years later, the same $100 only buys half. Not because you changed, but because the money changed. And that's where gold comes in. Gold is limited. You can't just print more of it. It has to be mined, refined, stored. It takes time and work. That's why it stays rare. So when people see inflation rising, when they see debt increasing, when trust in the system is falling, they start moving money into gold. Not because gold is magic, but because it's the opposite of paper. Let's take a real-world example. Imagine you're living in a country where the economy is shaky. Banks are closing. Prices are rising. The local currency is dropping in value fast. What would you want to hold? Paper that loses value every week? Or gold? Something the world has trusted for 5,000 years? This isn't just theory. It's happened in places like Venezuela, Zimbabwe, Turkey, Argentina. Even in big countries like the US and the UK, inflation has hit hard in recent years. People are noticing. They want something safer. And the more people buy gold, the more the price goes up. It's simple supply and demand. Gold doesn't rise because it suddenly got better. It rises because people are losing faith in the alternatives. Now let's clear up a common myth. Some people say, but gold doesn't earn me money. It just sits there. That's true. Gold doesn't pay you interest or dividends like stocks do. But remember, gold's job isn't to grow your money. Gold's job is to protect it. It's a shield, not a sword. When markets crash, when banks fail, when currencies weaken, gold often holds steady, or even rises. Think of it as your financial life jacket. You don't wear it every day. But when the storm comes, you're glad it's there. So, should you buy gold right now? Well, we'll talk more about that later in this video. But for now, you need to understand this. Gold moves because of trust. When trust in the economy, the government, or the banking system falls, gold becomes the safe place to hide. That's why its value has climbed so much over time, why people will keep turning to it when things get scary. In the next section, we'll look at what's happening in 2025 and whether the current gold price still makes it a good buy. Or if you're walking into a trap, stick around, because this part is where many investors get it wrong. So now we reach the big question. Is gold still a smart investment in 2025? Or has the best part already passed? Gold is trading at some of the highest prices ever seen, over $2,400 an ounce. For many people that feels expensive. Some are even scared to buy now. But here's something important. High prices don't always mean it's too late. Sometimes high prices mean that the problems gold protects against are getting worse, not better. Let's look at what's going on in the world right now. Governments are in more debt than ever. The US national debt is over $34 trillion. The UK debt is also climbing. At the same time, inflation still hurts everyday people. Food costs more. Rent is rising. Healthcare and education are getting harder to afford. And central banks, they're printing more money again, even after saying they'd slow down. This means the value of regular money is still falling. And when that happens, gold often rises. So yes, gold is high in price, but it might still have a long way to go. Here's something smart investors look at. Real interest rates. This means interest rates minus inflation. If you're earning 5% in the bank, but inflation is 6%, your real return is negative 1%. You're still losing money. And in times like that, gold becomes more attractive, because even though it doesn't pay interest, it often holds its value better than cash. In fact, central banks around the world are buying more gold than they have in decades. Countries like China, Russia, and India are stocking up. Why? Because they know the value of gold when things get unstable. And if the people who control trillions of dollars are buying gold, shouldn't we at least consider doing the same? Now let's talk about timing. Can gold go down in the short term? Yes, of course. Every asset moves up and down. There's no guarantee it will rise tomorrow or next week. But gold isn't a quick win investment. It's not about fast gains. It's about long-term safety. If you're investing for the next 5, 10, or 20 years, gold can help you protect your wealth, especially when stocks fall or inflation rises. So instead of asking, is it too expensive right now? Ask this. Do I want part of my money in something that's lasted 5,000 years? Do I want something real that doesn't rely on banks, governments, or digital systems? If the answer is yes, then gold still has a place in your plan. One more thing, you don't have to go all in on gold. Even holding 5% to 10% of your total portfolio in gold can make a big difference. It's like a seatbelt. You hope you don't need it, but when the crash comes, you'll be glad it's there. And remember, the real danger isn't buying gold at a high price. The real danger is watching inflation eat away at your savings while you do nothing. In the next part, we'll show you how to actually buy gold the smart way. Physical gold versus digital gold, where to store it, and what mistakes to avoid. Stick with me. This is where most beginners mess up, but you won't, because you'll know better.
So, you've decided gold might be a smart move, but now comes the tricky part. How do you actually buy it safely? Because here's the truth. Lots of people get ripped off when buying gold. They pay too much, they buy the wrong type, or they trust shady dealers. Let's make sure that doesn't happen to you. First, you need to know there are two main ways to buy gold. Physical gold, digital or paper gold, both have pros and cons. Let's go through them one by one. 1. Buying physical gold. This means you own real gold in your hands. It could be a coin, like a gold Britannia, or a Krugerrand, or a small gold bar. Maybe 10 grams, 50 grams, or even 1 kilo. If you're balanced, the biggest benefit of physical gold is you own it fully. No banks, no apps, no digital systems. Just you and your gold. It's private. It's safe from cyber risks. And it has lasted through wars, recessions, and total economic collapse. But there are some challenges too. You have to store it safely. That means a home safe or a bank vault. You might pay a higher premium when buying. For example, gold is $2,400 per ounce. That extra cost is their profit. If you want to sell quickly, it's not always easy. You'll need to find a trusted buyer. Maybe take it to a dealer. So where should you buy physical gold? Only from trusted and well-known dealers. Do your research. Look for companies with strong reviews and a long history. Avoid anyone who asks for payment in crypto or gift card. Promises guaranteed profits, has no online presence or reviews. Some trusted names in the UK-US market include Bullion or even your local bank. 2. Buying digital or paper gold if you don't want to deal with coins and safes. This is easier. You can buy gold through ETF. The best thing about digital gold is convenience. You can buy a small amount straight anytime, avoid storage headaches. But remember, you don't own the gold physically. You're trusting a platform or a fund to hold it for you. So again, trust matters. Make sure the company or ETF is legit, has a long track record, and clearly shows where and how they store the gold. So what should you do? Honestly, it depends on your goals. If you want true independence and long-term safety, go for physical gold. If you want easy access and small investments, digital gold might be better. Some smart investors even do both. They keep physical gold for security and digital gold for speed and flexibility. One more tip, start small. You don't need to buy a whole ounce right away. You can start with a gram or even half a gram. The goal is to build slowly with confidence. Gold is a long game, not a race. In the next section, we'll talk about how much gold you should own, how to fit it into your investment plan, and how to balance it with stocks, property, and cash. This is the part where you make gold work for you, not the other way around. Stay with me. You're almost at the finish line.
So now you understand why gold matters. You know how to buy it safely. But here comes the next big question. How much gold should you actually own? Should you go all in? Just buy a little, or skip it completely? Let's break it down in a simple and smart way. First, there is no perfect number that fits everyone. Your gold percentage depends on your income, your goals, your age, and how safe or risky you want to play. But here's what most financial experts suggest. 5% to 10% of your total investments should be in gold. That's it. It may not sound like much, but that small amount can make a big difference when times get hard. Let's say your total investments, including savings, stocks, property, are worth $50,000. Putting 5% into gold means $2,500. Putting 10% means $5,000. That's enough to protect your money if inflation gets worse, or if markets crash. but not so much that you're missing out on bigger growth in stocks or property. This is what smart people call a hedge. Gold is like an insurance policy. You hope you never need it. But when something bad happens, you're glad it's there. Now, some people make the mistake of going too heavy on gold. They put 30%, 50%, even 100% of their money into it. Here's the problem. Gold doesn't grow like other investments. It doesn't give you income, and it doesn't always go up fast. So if you put too much into gold, you might miss out on opportunities. Stocks and real estate can grow faster. It can give you returns, dividends, or rental income. So gold shouldn't be your main moneymaker. It should be your protector, your backup plan. Think of your money like a plate of food. Gold is the salt. You don't want a whole plate of salt, but a little bit brings balance and flavor. Same with your portfolio. Too little gold and you're unprotected. Too much gold and you're missing growth. The key is balance. Another smart way to look at gold is based on your age. There's a simple rule in investing called 100 minus your age equals percent you put in risky assets. So if you're 30 years old, 100 minus 30 equals 70% in stocks and growth assets. The rest can be in safer things like gold, bonds, or cash. That dose and tea mean you put 30% into gold. But part of that 30% can be gold. As you get older, you want more safety. Gold becomes even more useful then. And here's one last idea. You don't have to buy gold all at once. You can build your positions slowly over time. This is called dollar cost averaging. Buy a little each month, no matter the price. Over time, you get a fair average price and avoid the risk of buying at the top. This method takes away fear. No guessing. No waiting for the perfect price. It's just steady progress. So, how much gold should you own? Start with 5% to 10%. Don't go all in. Think long-term and build it slowly. In the next and final section, we'll wrap everything up. I'll give you a simple 3-step plan to make gold part of your financial life. Starting today, you don't need to be rich. You just need to be smart. And take action. Let's finish strong.
You've made it to the end, and it already puts you ahead of most people. Most never even think about gold. They trust the system blindly. They leave their savings in cash, hoping it will somehow grow. But hope is not a plan. You now understand why gold matters, why it protects your money, and why it could still grow, even in 2025 and beyond. Now let's bring it all together. Here's your 3-step gold plan, built for beginners. Simple, smart, and ready to use today. Step 1, pick your gold type. Ask yourself this: do I want to own real gold in my hand, or would I rather own it digitally for speed and ease? If you want something you can hold, go with physical gold. Coins like the Gold Britannia, or bars from trusted brands like Volcambi or If you want to start small or invest quickly, choose digital gold. ETFs like GLD, IAU, or platforms like Bullion. Both are fine. Just be clear about what fits your life and comfort. Step 2, decide your gold budget. Don't overthink this. Start with a goal. 5% to 10% of your total savings or investments. Even if you only have $1,000 saved, 5% is just $50. That's enough to buy a gram and get started. Don't feel pressure to go big. You can build your goals slowly, one piece at a time. Use dollar cost averaging. Buy a little each month. This helps you avoid timing mistakes. And remember, you don't need to buy a full ounce to be in. You can start with small buys or even digital fractions. Step 3, protect and review. Once you own gold, keep it safe. If it's physical, use a safe at home or a safety deposit box. Don't tell everyone you own it. Stay private. If it's digital, use strong passwords and secure apps. Only use trusted platforms with full transparency. Then, every 6 to 12 months, review your gold plan. Ask, is gold still 5 to 10% of my total net worth? Do I need to buy more, sell a little, or just hold? Treat gold like a long-term partner, not a quick trade. This mindset will protect you from panic and bad decisions. So let's recap. You now know Why gold has gone up over 1,000% in 25 years. How it protects you from inflation, crisis, and money printing, that it's not too late. The world still needs gold. How to buy it safely without scams or mistakes. How much to own and how to keep your portfolio balanced. And finally, how to start today with a simple 3-step plan. This is how you build financial safety. This is how you take control. Even in a crazy world, you don't need to be rich. You just need to be aware and take action. If this helped you, hit the like button. And if you want more simple, powerful money advice, subscribe for weekly videos that make finance easy. This is Zaro Wells. Thanks for watching, and remember, gold is power when everything else is paper.